numbers that have been trickling through. We also have with us Mr. Shreevar Kheruka, MD at Borosil Limited, to talk to us about those numbers with regard to Borosil. Mr. Kheruka, always great having you. Let me first start off with the kind of top line growth that you've clocked. It's been largely flat, right? Talk to us about what's keeping that lead with regard to top line. Give us a sense.
So the top line growth you're referring to is Q3 versus Q3 last year. This year, Diwali was earlier compared to last year, and that's just impact of I would say the time of Diwali versus anything else. If you look at the 9-month year-ended numbers compared to the same period last year, our growth is in the high single digits. That too, the reason is that there was a BIS implementation on one of our product ranges, which is our insulated bottles, and that's caused some supply chain disruption, and that's the reason for muted top line growth overall this year.
And how much of the impact of seasonality has been seen on top line, in your opinion, where Q3 is concerned? How much of that will likely unwind, or rather the unwind of that was already seen in Q2? And how should your full year FY26 numbers therefore look? Give us a sense of that.
Yeah, so if you look at our history for the last 7-8 years, we've been growing at a top line CAGR of more than 25%. And we had given a medium range forecast of 15 to 20% CAGR, and we stand by that. This year has been exceptional because of, as I mentioned already, the BIS impact. However, the supply chain has already moved to India, and we expect that next year to revert back to the 15 to 20% growth rate. As far as this year is concerned, I think the high single digits is where we'll end up, in the rest of the year as well.
And margins, Mr. Kheruka, do you expect to maintain that? So very strong guidance for FY27 is what I understand, because your base would also have shifted lower. My guess is you'll probably do top end of that 15 to 20% guidance that you're doing, because you've done 25% in the past, as correctly pointed out by you. But what happens to margins, therefore? The 16% kind of margin number maintainable?
Actually, we were, frankly speaking, disappointed with the margins this year because, again, the reduction in that one product category had the effect of reverse operating leverage. And next year, as that product category comes back, we'll have operating leverage once again. And we've, in general, been speaking of margins growing to the 20s in the next couple of years, and we stick by that. That's the general guidance we've given, and we hope to be on track for that once this supply chain issue is resolved.
And will that be linear, Mr. Kheruka? So from the 16 to the 20% number, a couple of years, will it be 18 next year and 20 thereafter? Is that how one can plot it?
Yeah, I think it's hard to give exact year on year kind of projections, because things keep changing at the margins. But overall, yes, I think it could be a linear kind of story there.
Right. But Shreevar, what category amid glassware, opalware, or non-opalware, or glassware do you see as the biggest margin driver and growth driver over the medium term?
So I think in general, whatever products we make in India, which is at this moment glassware and opalware, these are the margin drivers from an absolute margin perspective. Now, as the bottles, the insulated bottles come, we've set up a manufacturing facility. It'll start very, very shortly. That will also start becoming margin driver. But just a caveat here, we also look at ROCE. So the ROCE is also important. So there's some categories which may have lower overall EBITDA margins, but from a ROCE perspective are very attractive because the capital employed itself is quite low. So, we look at it from both perspectives and not just one. But to answer your specific question on EBITDA, I think it's going to be glassware and opalware in the short run that drives those margins upwards.
Sorry, which segments did you say drive higher ROCE?
The glassware and the opalware are driving the margins. The ROCE is driven by all our categories drive quite good return on capital employed numbers. So we're, even though some categories margins may be lower, the EBITDA margins may be lower, but the ROCE is high. So that works for us as well.
Understood. So no change in your product mix for the next 2 to 3 years, I'm guessing?
No, I think, as a general trend, I think India is eating more out of glass, which is great for us. We've been pushing that. So people have been substituting away from plastic and eating glass because of the health benefits of the product, the fact that you can microwave it and eat hot food, on demand. So I think we will see more glass sales in the future as a percentage of the overall mix, and we are well geared up for that.
What about the inventory unwind, Mr. Kheruka? That was one of the concerns in FY25. Have you seen all of that translate to cash flow in FY26 or by end of FY26?
Yeah, I think we've had a very healthy operating cash flow this year, and we'll continue seeing that going forward. So inventory or working capital is not an issue that which is on top of mind at the moment. We're well covered both on the inventory as well as on the receivables side. So the operating cash flows will all now be able to be used for capex, and we are in general transitioning more to a make in India, kind of product mix, which we are all also very excited about. So there will be substantial capex upcoming, and this cash flow will help drive that.
Okay, which direction in terms of what are you setting up or utilizing the capex for, and what are the timelines like that you're setting? You'll likely do around 200 crore of free cash flow if I've got it right. Correct me if I'm wrong. At least this year, that's the kind of number you'll target, and where do you utilize that?
Yeah, that number is about right, and that number will have an upward bias in the coming years as margins improve. But broadly, we are spending. We spent about 65 crores this year on setting up the manufacturing for the bottles, which I spoke of earlier. We'll be expanding our glassware production in the next year to 18 months. That will require capex. We are setting up, large-scale solar power projects to reduce our cost of power. These are captive consumption power projects, which will also require close to 100 crores of capex. Then there is also new lines of business that we are considering, which have not yet been approved by the board, but will be, consuming capex. So we have a pretty robust, I would say, utilization of the capital in the coming 2 years, I would say.
Okay. Thank you so much, Mr. Kheruka, for coming in and speaking with us. It's been a pleasure understanding this. And of course, a larger conversation on this front warranted, because you'll likely be at an inflection point come Q4, and FY27 will be obviously a very interesting year for you, and I'd love to have that larger conversation as well. So I look forward to that.
Thank you.